And joining me on the line is the founder of gold forecaster Julian Phillips. Julian, there's been a lot of talk since Hugo Chavez decided to nationalize his gold industry, and probably before then as well, about gold buying by central banks. It has been a focus. There have been agreements by the central bank gold agreements, I should call them. They have been around and about for quite a long time. We haven't seen an awful lot of selling by gold, of gold by central banks recently. You wrote a very interesting piece about the implications, particularly for more emerging markets, economies, to perhaps retain a lot more of their gold production. Why do you think that this is likely to become a talking point going forward?
I think acquiring gold in the gold market is really a very difficult thing for governments to do. The moment the market knows they're around, you get tremendous emotional reactions. You get the traders piling in, the speculators ramping up the gold price on the instant. And it really...
As we saw with India, for example.
Yes, and it spoils the market for the others. So a central bank that wishes to increase his volume in reserves, whilst he's not price sensitive but is volume sensitive, he's not happy to do that because he not only does he ramp up the price, but he loses the volume from the market. It's snapped up by these speculators who try and sell it back to him at a higher price. And that is not the professional way to acquire gold. So if you produce in your own country, you simply make an agreement with the gold miners, or you order them, as Chavez has done, to sell their gold to the government. The government pays in local currency, and it goes straight into the vaults. It's assayed to the right quality, it meets all international standards, and it is kept at home, and it's part of the reserves. And the effect on the gold price is zero, because it's done off-market at a market-related price. So the only time it has an impact is when that gold doesn't appear on the supply side, and that's down the road. And buyers then find, there's that much less gold to buy. So it's the most efficient way for a nation to stock up on his gold reserves. And I think Chavez, whilst no doubt he's driven by emotional political factors, has made a very, very smart move. If you look at the portfolio, he's not only, and it's his central banker doing it, but he's not only capturing as much gold as he can, and I believe there's at least 1,000 tons of gold in Venezuela's ground. He's probably got the largest oil reserves in that part of the world too. So his cash flow will be oil. His reserves are now being diversified into the BRIC country currencies, and into gold. So going forward, it looks a very, very sound growth portfolio.
Mm-hmm. But now, of course, at a global level, in terms of the gold market itself, Venezuela are a relatively small producer, and so the likely impact down the line from a supply point of view, not quite as big as, say, if Australia or South Africa or the US did that, for example, and it would have much bigger ramifications were a large producer to do that. But is this likely something that we're going to see more and more smaller countries doing?
I think so. I think they're following the bigger countries. If you look at Russia, I believe it's doing somewhat similar, as well as buying in the open market, as we see from the World Gold Council figures. And I believe China has the most interesting way of buying its gold. It uses an agency to buy, so it doesn't have to report any purchases except when that gold is delivered by the agency to them. The last time it was delivered, I believe it was in 2008, when they announced 454 tons of gold delivered to the People's Bank of China, which upped their reserves to 1,054. In doing so, that really had quite a dramatic impact on the reserves. And I look very carefully to see, is this an average of 91 tons a year, or does it meet the previous year's local production? And I tend to favor the second, that it meets local production. So if you take the same principle that this agency is acquiring locally produced gold, the next statement should be around 2013. And I personally wouldn't be at all surprised to see an increase of at least 2,000 tons. And at the same time, the Chinese government has licensed so many foreign banks to bring gold in. So the Chinese people are buying gold from the international market, and they're left with the price factor, which we're watching in the last few days, is quite dramatic. And that is taken off the international gold market. So there's a twofold channel of gold into the country as a whole. So I wouldn't be at all surprised to see total Chinese holdings of gold around about the 5,000-ton mark in 2013. Now, if Russia and China are walking those roads, it makes sense for the smaller countries to follow, such as Venezuela, and then the other gold-producing Kazakhstan announced it's going to do the same. So the trend has already started.
What are the implications down the line for supply, especially in light of the fact that the gold majors, for example, are struggling to find significant reserves that will replace, or significant deposits that are likely to replace reserves?
Well, it's horrific. If the present gold supply is around about 3,000 tons of newly mined gold. Now, you take away Kazakhstan, Venezuela, China, and Russia, we're talking well over 550 tons of a 3,000-ton newly mined gold supply chain. Such a reduction in supply to a burgeoning Asian demand, alongside possibly a growing developed world demand as the currencies tend to decay, then clearly there's going to be a very large and unchangeable shortfall on the supply figure.
I suppose then that begs the question what the miners are likely to do as a result of that, because if prices go up, clearly more marginal assets become viable, but perhaps it also raises concerns around the continued rise of resource nationalism with the more out of the way deposits that perhaps are the only big elephants left.
Absolutely, and in fact, as an investor in gold mining shares, I would tend to put a big circle around those countries possibly able to, and I call it a form of soft confiscation, to take locally produced gold into their reserves. And I would favor the countries most unlikely to, such as Canada, the United States. And those deposits would be far less vulnerable, not entirely without vulnerability, but certainly far less vulnerable to such policies.
You mentioned currencies, and there's been quite a lot of talk about some cables that came out of WikiLeaks with regard to China and the US embassy and around the use of gold as I suppose a pawn in the currency wars, if you will. What do you make of what's been going on there?
Absolutely fascinating. If you go back to the 70s, when the United States and the IMF tried to write gold out of the system and passed all sorts of little regulations to do so, it was done to promote the dollar and subsequently in 1999 the euro. And the sale of gold, pushing the price to around about $300 an ounce, really discredited its reliability, 850 down to 300, named, labeled as a barbarous relic, etc., etc. The US dollar, which became the sole oil currency, suddenly had the same characteristics as money previously had. It had the very vital commodity link, which forced everybody worldwide to buy US dollars in order to buy oil. And as such, the US dollar, despite its trade deficits going way back before that time, and despite its clear weakness in terms of value measurement, became the sole world global currency. When the euro came along, similar policy, but slightly different in that they capped the gold sales, but nevertheless holding the price down so that the euro would be more quickly established as a currency. So the developed world chose to sell gold to do that. But now we look at the global monetary system. We have the emerging world, which is not on the same page as the developed world, has different objectives, and certainly has no interest in establishing the euro and the dollar as a permanent global reserve currency. In fact, they're most alarmed at the misbehavior in the economies of both those areas. And so when it talks about using gold to back the yuan or renminbi, it's saying we will add value to the currency because currencies are now decaying and therefore are not being taken by the average man in the street as a value measurement. Yes, as a means of exchange, but not as a value measurement. Even Mr. Zulik of the World Bank said that gold should be used as a reference for currency values. And we're now moving to the time very rapidly where you don't ask what the price of gold is, but what the price of a currency is in terms of gold. The dollar, $1,900 is worth an ounce of gold, not an ounce of gold is worth $1,900. And because of that, the Chinese are thinking along the same lines. We're moving into a discordant world where it's not enough to say we have a strong economy and we'll always be a good government basing our policies on sound money. It's so well known that they don't do that, nor does anybody else. And even this morning, the Swiss National Bank is saying we will intervene to hold the exchange rate at 120 to the euro. So now with that as the picture, it's quite wise of the Chinese to turn around and say, we will use our reserves and we will make them grow to give a sound basis for our currency. Indeed, I do see a time when, as an inactive reserve asset, as gold is now, it might well be used on a collateral basis by central banks at emergency times. I do appreciate that governments can't do that because central banks are totally independent of government, and never the twain shall meet if I'm to believe everything I'm told. But as a collateral base, as I've mentioned to you before, I looked to the BIS and the gains of last year, and I suspect that this is quite a hot topic behind closed doors.
No, this is not the same, and I think it's worth pointing out. This is not the same as a return to a gold standard, which I think there is a lot of talk about in the press, and it seems as though that it's to my admittedly uneducated view, really, that it's unlikely that we'll see a complete return to a return to a complete gold standard, but perhaps, as you say, some form of collateral.
Yes, I agree with you 100%. In the gold standard, use gold as partly a means of exchange. I don't see that happening. I think the price has to be at least 5 figures before that can happen, and probably quite a large 5-figure number, because it's got to match the entire issue of money worldwide, and I don't think that is feasible. I think it would cause so many ruptures in the world monetary system as to emphasize its lack of credibility. So gold has to be used in such a way that a small amount will provide a disproportionate value in terms of any multinational transaction between central banks. And the only way I can see that happening is as collateral. And a small amount can, if you take, for instance, today, imagine Greece taking its 111 tons of gold and dropping it into Luxembourg Bank to satisfy Finland. I don't see that happening, but if they did, it would cause such a flurry of alarm and incredulity that I've got no doubt Greece would be able to borrow anything it wanted against that amount.
Julian, just quickly to close off with, and looking once more at Greece in particular as a good example of perhaps the problem with a return globally to a fixed currency, if we're already seeing what problems are being experienced in Europe.
Yes, I don't see a fixed currency system working ever again. Europe is the classic case. You've got a strong Germany, which actually needs a strong Deutschmark. You've got a weak Greece, which needs a weak drachma. You put the two together under one currency. That's a fixed exchange rate. And the only result you can possibly have is that all the capital finds its way up into Northern Europe, leaving Greek investors invested up north and not in their own economy, making sure that Greece remains a nice holiday resort, period. So fixed exchange rate, I think, are a disaster for a diverse set of economies worldwide.